Now, I just said a heap of money. Now, a heap is Australian slang for a lot of money. For everyone out there who doesn't understand what that word is, heap means a lot. Hey everyone, so it's pretty obvious from the title of this, I'm taking a look at Airbnb today. So I'm going to do my quick valuation just like I've done in plenty of previous videos before on all sorts of companies. I'll go through my 9-point checklist, give you my opinion at the end. I'll also give you a fair value of the company right now as well. So let's jump into it. So what I'm doing here on my channel is just doing a high-level approach to see whether we should go off and do a deep dive into the company. And if you do want to understand how to do a deep analysis of a company, I strongly recommend going to Hamish HODDER'S course. Now, the reason I'm recommending it is because, look, I never really wanted to put a course together myself. I'm still learning a lot about investing, and I'm reading a lot of books, and I'm studying a lot. But Hamish HODDER has done a lot of this already, and I think his course is fantastic. So instead of me putting in another course into the world, Hamish HODDE'S is the best out there. And he has kindly enough given us a discount code for my audience and my friends and family. If you want to take advantage of that, it's 30% off, and here's the code here. Look, I think he's a great guy and the course is fantastic, and yeah, that would be my recommendation to learn more. So turning back to Airbnb now, and the reason I'm doing a video on this is because I use Airbnb all the time, and I just used an Airbnb and I had totally forgotten to ever analyze this company. So I'm going to take a look at it today, see what I actually think. Now, we all have to agree here that Airbnb has completely changed the travel industry. 6 or 7 years ago when I left Australia and I started traveling the world, I'm using Airbnb all the time, and I was never going to stay in a hotel, and I didn't really want to stay in a hostel. I'm a bit too old for that. So an Airbnb was a perfect in-between place between a hostel and a hotel. And look, it was perfect for me. It meant I could travel for a lot longer and my costs were lower, and I could also live in an apartment with a kitchen and all sorts of things. And it was ideal for me personally, and obviously it's ideal for a lot of people out there throughout the world. And it gives you the opportunity to explore different regions and different areas as well that maybe you wouldn't have seen if you just stayed in the hotel in the city center. So look, I love Airbnb, but that doesn't make it a good investment. We have to go through the financials and understand the business to see whether this is a good investment or not. Look, I think it's going to be probably overhyped because it's already at a $100 billion market cap. But I guess there's hardly any real competitors out there. Like I said, it's somewhere between hotels and hostels, and I don't think there's much in between there. And it's got a very, very worldwide brand. Everywhere I've gone, there's been Airbnbs everywhere. So look, I don't think they have any real competition. The co-founder still leads the company, which is a great sign. And yeah, like I said, I use this all the time, so I'm very familiar with the product. So let's see if it is going to be a good investment or not. So I'm going to check for the revenue growth first, and the revenue for the last, well, I can only go back to 2017 and it was 2.5 billion. Now it's going to be about 4.5 billion. It was nearly 5 billion in 2019 and it dropped down to, still did 3 billion in revenue in 2020. So look, obviously the pandemic slowed things down there a fair bit for Airbnb, which is to be expected. And it's bounced back reasonably well. I'm pretty impressed already. So yeah, okay, I actually think I'm going to give that a tick because 2017 to 2019 was really strong growth. A bad year 2020, but it's already rebounded. So I'm actually going to give that a tick. Next up is gross margins, and 40% is sort of the number I'm looking at here. So anything above 40%, it means they have a lot of extra margins, means something can go wrong, like a pandemic can go wrong. And hopefully they can still make some sort of profit or not make a dramatic loss anyway with those high margins. And gross margins, this is pretty much just a software platform, so it's in the 70% range, and that's fantastic. We'll give that a tick. All right, so far so good for Airbnb. Now we're going to look at return on invested capital. Essentially, this is how the management team are investing back into the business to make more money. And return on invested capital, well, we've only got 2 years worth of data here, and it's both in the negative. So I assume they've been probably making an earnings loss here. That's probably why that's happening. Yep, earnings per share is in the negative. So look, we don't really get a feel for a return on invested capital. We'll have to give that a cross. Next up is debt, and debt is the number one reason why any company gets into serious trouble. Now, I'm going to have a look at the short-term responsibilities. So by looking at that, I look at the short-term assets of looks like about $10 billion, but they have $14 billion of short-term assets, which means they can cover that short-term liability, no problem at all. So we'll give that a tick. But Something that we're going to see a little bit later is I think they've just raised a heap of money. So we'll have a look to see whether that's the case. Now, I just said a heap of money. Now, a heap is Australian slang for a lot of money. For everyone out there who doesn't understand what that word is, heap means a lot. Now, we know they've been making an earnings loss, but maybe they've been free cash flow positive. So to check that, I want to see that growing along with revenue. And look, it's been all over the place. Minus 667 million last year. Obviously, that was pandemic related, but it has bounced back really strong, the free cash flow number anyway. And I had a look at the forecast for the future, and it looks like it's going to be around about that $1 billion to maybe $1.5 billion number for the next year or two. So we're going to use that in our calculations a little later. We can't really give this a tick though, because this is pretty inconsistent free cash flow, and we don't really have that many years to go back either. So it's a bit difficult. Now, for those of you who are new out there, you'll need a brokerage account to buy, sell, and hold your shares. Look, I don't recommend Robinhood. I'm going to have a video very soon about why I don't like Robinhood. I use Interactive Brokers and Saxo Bank. The reason is they give me access to international markets, and that's really important because some of the best companies in the world are not in America and they're all over the place. So I want to not narrow my search field down to just one particular country. I want to be able to invest everywhere. These companies also have long histories and their fees are low. If you want to have a play around with a demo account for Interactive Brokers, use the link in my description. You can have a feel for what you think of it and whether you think it's something you'll be able to use. It's pretty simple, I think. It's self-explanatory, but have a play around with it before you actually go and sign up. Okay, next up is shares outstanding. We want to see this number at least stable, maybe even going down. If it's going up, it means we're getting diluted. And I can tell you now, if you're a shareholder of Airbnb, you have just been extremely diluted. It's gone from, looks like, little under 300 million shares to over 600 million shares. The company's just doubled the amount of shares outstanding. So look, that's terrible, but I can understand why they did it, because the pandemic happened. They probably need to make sure all of their debts are going to be covered and all their employees were going to be paid and all that type of stuff. So look, they've just issued, instead of getting out heaps of debt, said the word heaps again, they have issued a heap of shares. So that's what they've done, and we've got to give that across. Now we turn to inside ownership. This is really important because we want the management team aligned with the shareholders. It means that if the incentives are all aligned, it means they're doing things in the best interest of their long-term shareholders, not just for their salary. So to check that, we look at, here we go, the leadership team: Brian Chesky, Nathan Blachersk, Joseph Gabia. Wow, I don't know how to say those names. So we've got compensation for these guys at 120 million, but he's got $11 billion worth of shares in the company. $22 million for Nathan. He has $10 billion in the company. Joseph is 22 million. He has 1.3 billion. So as you can see, the leadership team here, they have pretty big salaries, but they have billions of dollars worth of shares. So they're incentivized to see the share price improve, not about their salary. They're getting paid a lot of money as well, but compared to their ownership of the business, it's very minuscule. Next thing I go look for is whether there's any super investors invested in the company. And I've looked around and I couldn't find any super investors that I really like invested in this one. Now, the reason I do this is because if it's gone through their filters, it would mean that these guys have been doing this for decades and decades. And if it's past their filters, it means it's probably a good investment and it stops me being an idiot. So it would build up more conviction in the idea for me, but I couldn't find any super investors in this one, which is probably a red flag. Now, last but certainly not least is the price that we're going to pay. So look, I love this company. I really do. I use it all the time. So if this is really cheap in relation to how much money it's making, maybe this is a good investment, but I haven't factored in the shares, that share dilution either. When I look at my intrinsic value calculator, it doesn't factor that in. Now, I've had a look at what the analyst estimates are for the growth rates. They're thinking 40% for the next year. I'm going to say it's going to be 40% for the next 5 years. So that's not conservative at all. I would say that's very aggressive. Then we're going to say it returns back to some sort of normal 15% number as it gets a lot bigger. I'm chasing a big discount rate of 30%. The reason I do that is because I really want about 20% on my investments. But if I go for 30%, it's sort of like, well, I'm shooting for the stars and I might land on the moon kind of idea. So I aim for it's really factoring in a big margin of safety. The multiple I could sell it for, I've gone and input all the free cash flow, shares outstanding, all those numbers as well. Now, this calculation doesn't factor in the share dilution like I just said. And it's telling me I want to buy this at around about call it $50 a share. And if I go look at the current price, we're at $175. So I want to buy it at $50. That means it's got to fall like 70% or something like that to get to the range that I'd be happy with. Let's go find what its fair value is, assuming all of these exceptional growth rates. What I do is I change this to 10%. And it's telling me I'd want to buy this at $165. And the share price, what was it? 170. So it's around about the fair value of the company right now. If it can grow at 40% for the next 5 years, if the shares aren't getting diluted anymore, and it's only fair value, you're only going to get 10% with no margin of safety. So look, I don't have any other way to say this except it's just seriously overvalued. So my opinion on Airbnb is that, well, growth looks like it's going to come back, and analysts think 40%. I've even just said that's 40% for the next 5 years because it's a great company. I think they have a strong competitive advantage at the moment. The founders are still leading the company, which is great, but that shares outstanding number, we're getting seriously diluted if we're investing in this company. That's dramatic, and I don't like that. And look, the price it's like it has already rebounded and the company is fully successful and the pandemic is over and it's growing super fast and everything is perfect. But look, I think that means that we're gonna have to wait like 10 years or something for the earnings of Airbnb to catch up to the actual share price. Maybe it doesn't take that long, I don't know. I'll reassess at some point, but the current share price, way too high for what I would be comfortable with. Gives us no margin of safety either. So I would say this is in the high risk, probably low reward category. And that's not the type of investment that I want to make. Now, if you did get some value out of this video, if you could hit that like button for me, it would be greatly appreciated. I can take the criticism if you think I'm completely wrong, by the way. Don't forget about Hamish HODDER'S course, and I'll see you in the next video.